Okay, welcome once again. The last time, or in my last video, we talked about this simple strategy, quick strategy, and it was most related to the moving average, how to use the moving average to pick trade or to formulate a trade setup. Okay, so we look at a 1 hour chart and then we saw something called CTC, cross, touch, and close. And we said we want to see the moving average cross each other. We want to see price, touch, go back to the 48 moving average to touch it. And then we want to see price close above after touching. So after touching it, you can have a couple of candles in here, but the trigger is when the market closes above the 12 moving average. Okay, for a downtrend, it is when the market closes below the 12 moving average. Okay, so we want to touch the 48, close below or above the 12 moving average, depending on the trend. Okay, so, and we also said that sometimes you can have a touch or close, but the risk is too huge. Okay, for instance, we closed above here. This is our entry, and this is the stop loss. Okay, so entry to stop loss, we have about 36 pip stop loss, which is very wide, very big, right? But you can be rest assured that most of the times price will move away. Okay, so now in today's video, what we are going to look at is how to reduce the stop loss. It doesn't work in all the circumstances where you're going to see touch and close. Okay, but you can also reduce the stop loss once we have a cross, right? You can change it to a 5-minute chart and then look at how the price is behaving or reacting to the 5-minute moving averages. Okay. Now, the question is that why 48 moving average and why 12 moving average and not 50, 20, 70, 80, right? So the thing is that we have a daily chart. Okay, so you can have a daily chart and a moving average on a daily chart will be 1. So for instance, this is a daily chart taking off all the moving averages, right? So I have only the 48 moving average on it. Now, if I change the 48 moving average to 1, okay, to 1, it will align with the candles. As you can see, it's aligned with the candles. Now, it will make much sense if I change it to a line chart. So now, after changing to a line chart, we don't see any difference between the 48 moving average and the line chart, right? They are the same. So on every time frame, a moving average of 1 will align with the line chart, meaning that it is going to mark the moving average based on 1, 2, or 3 candles. After each candle closes, right, the moving average is going to mark. So that's why a 1 moving average is. Now the question is that if 1 moving average, okay, is the same as on the daily chart, is the same as a daily line chart, then can I move this 1 daily moving average to a 1 hour chart and have the same representation? So now it means that this one candle, this one candles that you are seeing here can be changed into a 1 hour chart, and we are going to have 24 candles within this one candle. 24 candles within one candle. So it means that if I want the daily moving average on my chart on the 1 hour, I can use the 24 moving average on it, right? So now I'm changing this to 24 moving average. And then back to 1 hour. Okay, so what you are seeing here is what? An expansion of the 1 hour, one day, one moving average on the daily chart. So this is the same line graph that we saw on the daily chart that has been changed, expanded to a 1 hour chart. So each marking is 24 hours, which is 1 day, right? Now, what this strategy is about is that we are using 2 days moving average. 2 days moving average means 24 plus 24, 24 times 2, which is 48, to give us the long term, the 2 days moving average. And then we are using a half day moving average, which is 12 candles in a day, or 0.5 moving average on the daily chart, to give us was a 12. So that is why this, we use 48. We use 48 and 12. Okay, but you can equally use what? 24 to give you a tighter entry, 24 and 12. All right, so 24 and 12, this close below, we had, it's the same thing. You're going to have the same kind of trade setup, right? But for a good confirmation, if the spaces between the two moving averages is a bit averagely wide, it gives you a better confirmation. So for instance, here, we had a touch. You can see how we touch the 48 moving average, the 24 moving average. If I change it to a 48, we will not touch it, right? If I change it to 48, we will not have the touch. Okay, so we had a touch here, but this one failed. All right, so that is it. But that's the reason why I use a 48. I use a 48 for 2 days confirmation and against what? Half day confirmation. So that is it. Now, we decided that we are going to see how perhaps you can reduce the stop loss. But the question is that, looking at this daily 1 hour chart. Okay, so this recent chart, right? Looking at this area like this. Okay, how many of us will think this is an accumulation and that we have a spring? Okay, we have a spring, something like this, and that the market is going to continue going up after trading below all this. Many people, many of us will do that. Many smart money traders will do that. Okay, right. This consolidation. This consolidation. You may think that the market is about to go up, right? You may think that the market is about to go up. But once you have the moving average on it, that idea will not be part of you, right? Because one, we came to touch it, we closed below it, very strongly. We had a very strong close. And after that, price was unable, on several occasions, unable to take previous high. So for instance, in this one, this market couldn't make it to this high, close below. This one couldn't make it to the previous high. This one too, this one. So at the end of the day, you are having that intention, you are getting the idea that the market is moving to the downside. Look at here, the market touched this, okay, and the next candle closed below it. Then we saw this no demand candle, right? Markets try to push up, right? But there were no strength, right? And the volume associated with this is lower than the previous two volume, this candle, okay? This is a signal that we are not able to go up. So currently you see that after price closed below it, all couldn't go up, right? Meanwhile, some people were expecting reversal at this particular zone because of the way the market was behaving. Right, because of the way the market was behaving. Now, you could have, if you use volume, you see that volume is decreasing, right? So it's a sign of reversal. but the moving average is telling you something different. And if you look at it in general, right, you will see this. You broke structure to the upside. You broke structure to the upside because we had a low sweep below this previous low and closed above this. So many of us will be buying this. We're buying this, but with a moving average telling you that no, we are closing, we've closed below, we've crossed, then you should be looking forward trade to the downside. Right, you'll be looking for trade to the downside. So here, could have taken this, or this. Right, even me myself, I had a setup here looking for a buy here, around this area, right? But moving average will stop you from doing that. Okay, now for this lesson, we are going to also look at how to reduce the stop loss, right? How to reduce the stop loss. So my first example is going to be Euro GBP. Okay, so once we have had a cross, once you have a cross, once you got a cross and the market came back to the 48 moving average close, you look at the area where we had a close. Okay, so we had a close. This candle closed below this moving average here. So this is where we had a close. Okay, then you mark the wick of that candle if there is a wick. So we have marked the wick. The thing is that we do this to know the extreme. I'm using this as an example because at this point, I can't use a replay. Okay, so now when you do this, you get to know where the market closed and the extreme of it. Okay, so that is because I don't have a replay. That's why I'm doing this. Then you mark. The next thing, you have to know the time of that particular candle. That was the 8 o'clock candle. That was the 8 o'clock candle. And this is a 9 o'clock candle. So you have to look at the time. So now you switch, after doing this, you switch to the 5 minutes chart. So you assume all this were not there. So when you go to the 5 minutes chart, you again look for the same methodology. Cross, touch, and close. Okay, on the 5 minutes, we had a cross here. We have a cross here, which means that this thing we saw in a 1 hour, okay, this thing is a peak on the 5 minutes. So we have a 5 minute peak here. We have a 5 minute peak here. A peak has been formed on the 5 minutes. Okay, so this is a 5 minute peak. This is a 5 minute peak. And we know that if this is a 5 minute peak, price is not going to break this 5 minute peak. Then, interestingly, this is where the candle closed. When the new candle started opening, we had a touch. So we have a cross here. A cross. We had a cross. We have a touch and a close below it. Okay, so me changing it to a 5 minute, I'll be looking for trade around this level. Because maybe I'll think smart money. Okay, the price will be coming back to this particular level or even coming back to take this. But once you have the touch and the close below this level, you can take a trade. All right, what is your stop loss? Your stop loss will be this particular touch, right? But normally this is what the entire stop loss for this particular trade. It's going to be wide. Okay, so 21 pips, right? 21 pips reduced to 3 pips. Cool. Or even reduced to this level, right? 9, 10 pips, not bad. Okay, so this is how you can easily take the entry. Okay, so we do another example. Okay, so now we have a peak here. So this is where we closed. We closed below it, and this is a long way, very long, right? So normally, if you don't have the moving average on it, okay, you'll be looking for a trade around this particular level, okay, with this liquidity here. But moving average will not give you the same. That's why you have to combine it with smart money. Okay, so now we had this, we closed below it, and if you change it to the 5 minute, you are going to see that you can enter a sell around this level here. You get a sell here. Eventually your stop loss will get hit, right? Because yes, price traded below the previous low, which is the first portion where you can take your profit. It's not too big, because if you have an entry here and here you have a 17 pips or 16 pip take profit below this, right? And then it came back. So now again, on the same 1 hour, you had a peak formation because we broke this and closed below it. Close below it. Now, the reason why this it worked if you are using it right, but it didn't work on it will not work on the 5 minutes. I can see that it will not work on the 5 minutes. Let's check. Let's check 5 minutes. Okay, this is the candle. Okay, so see, we had a valid peak formation. A valid peak formation, right? Because we crossed here, we touched, we closed below it. So your entry will be around this level, right? Now, price came back to this candle. So it means that if you open a 5 minute chart, okay, it's worked. If you open a 5 minute chart, you look at the area. So here, this is a high resistance. Okay, this is not major low, right? We resisted this level before breaking it, right? So this is a strong supply zone, and it's a break. This is a mitigation block, right? You have a mitigation block here, okay, aligned with what? Another order block in front of it, like this. Okay, so if you're looking at this, you could have taken your trade around this level, right? But using the CTC, you would have entered here and you have all these drawdowns, okay? But eventually, because price has done it on the 1 hour, okay, has done it on the 1 hour, you know that we are going down, right? So now we have another peak. Price close below the 48, the 12 moving average. So it closed here on this candle, and this is the extreme of the wick. This is extreme. Okay, so you can go to a 5 minute chart to see what happened. Okay, so this was the first peak. This is the second one. This one was an easy trade because it had double touches, right? So first cross, confirming this peak, right? So normally this will be your trade. This is where we closed. Can be your trade. This will be your stop loss, and maybe your 1 hour target somewhere low, right? So let's see how many pip stop loss we had. Okay, 16 pips, right? But now, if you use the CTC rule, you crossed, we touch, we close below. This is your entry here. Entry. Entry, and then your stop loss. Okay. reduce to 8, right? So that is it. Okay, so had more consolidation here. Here, we touched, we close below. Okay, we close below, very far from it. Now, if we close below after touching, all right, and you see that you have to reason with how to take the trade. We close below this one here. Definitely, if you enter a trade here, then it means that your stop loss is going to be here. It's too wide, it's too big. You can't do that. So you have to leave some of the trades. Okay, you have to leave some of them unless you are using proper risk management. Maybe entering with what small lot size. Okay, so this is 14. It's too far, right? Here again, we close below. This is also too far. You see, it's very far from the moving average, because if this is the peak, it's far. Here we had a cross, we closed below, not too far. Okay, so you see here, most of the body of the candle, okay, that close is outside the moving average. Most of the body is outside a moving average. You can see this one. Okay, this one too, most of it is outside. But if you compare it to, for instance, if I take the distance from where we touched to where we closed, okay, and looking at the moving average, there are more spaces above. If you take that here, yeah, there are more spaces above than more space below. Okay, here, this is going to be, if this is going to be, yeah, this is where we touched, okay, to where we closed. To where we close. Okay, to where we close here. It's not too bad, right? So you can take this particular trade with 5 pips, right? Okay, so now here we touched, strong rejection, we close. It's a good one. It's a good one, right? Very good move to the downside. So if you are scalping, this could be good for you, right? So don't use it without your smart money. Do your smart money analysis before. Okay, so next one, USD card. Okay, so that one, we had a lot of trades. We cross. We have a peak formation here. We cross here, right? We also cross here. Okay, so now peak, we touch the 48, we close below it. Good trade. We touch the 48, we close below it here at this point. Closed below it at this particular point. It's a good trade, right? We touched it, we close around here, we close around here, we close around here, and then you could be following the moving average for a very long time. All right. USJPY. Yes, very good example. Touch, we closed above. Okay, let's use a 5 minute. Use a 5 minute. Okay. So peak confirmation, peak formation confirmed, peak formation confirmed. We have a cross. cross. I have a cross here. Okay. But no touch. By the way, no touch. Maybe a trade you will miss. Except if you are trading this particular smart money. This is a miss. Okay. But now, in the next video, we are going to look at how we trade without touching the 48 moving average. Okay. So you can see that sometimes on the 1 hour, we have alignment to the 12 moving average. You can see this. We respected the 12 moving average. This one too respected the 12 moving average. There's a way you can trade that one too. But I think I'll end this particular lesson here. And end this one here. Okay. So we touched, we closed. Nice. Nice trades. It was a very good one. Right. This is a very good one. Rejection. Very good rejection. All right. So I'll end it here. Bye-bye, guys.